Imagine you had the same amount of money to put to work for the next 20 years. One path puts it inside a specially designed whole life insurance policy, where the goal is to build cash value and eventually borrow against that value. The other puts the money into an S&P 500 index fund and lets the stock market do the heavy lifting. Both strategies have passionate supporters. One side says, why give your money to Wall Street when you can become your own banker? The other says, why pay insurance costs when you can simply own the market? But here's the problem. Neither slogan tells you where the money actually goes. Because infinite banking isn't simply an investment account with a different name. It's a life insurance strategy built around a cash value policy, premiums, policy expenses, cash accumulation, and policy loans. And the S&P 500 isn't a savings account either. It's an equity investment whose value rises and falls with the market. So today we're ignoring the sales pitches. We're going to compare the mechanics. Where does the money go? What are you paying for? What happens when you borrow? And most importantly, under what circumstances can each strategy make sense? Because the answer isn't simply stocks win or insurance wins. The real math is more complicated. Let's start with the biggest misconception. Infinite banking is not a specific type of insurance policy.
It's a strategy commonly built around participating whole life insurance, where the policy is designed with an emphasis on building accessible cash value. Whole life insurance is a cash value form of permanent life insurance. The policy can accumulate cash value, and policyholders can generally borrow against that value. That sounds simple, but your premium doesn't magically become an investment balance. Part of the money goes towards the cost of insurance and other policy expenses. The remaining amount contributes towards the policy's cash value. And depending on the policy, there can also be dividends, guarantees, surrender considerations, and other contractual features. That's why looking at the premium alone can be misleading. Now compare that with an S&P 500 index fund. Here you're buying exposure to a basket of large US companies represented by the S&P 500. There isn't a life insurance death benefit attached to the investment. There isn't a policy loan feature. And there isn't a contractual promise that the market will maintain a particular value. Instead, you own an investment whose value changes with the underlying market. So from the beginning, these aren't identical products. One combines insurance with cash value, the other is primarily an investment. And that distinction changes the entire comparison. Here's where the comparison gets interesting. Suppose someone starts putting a consistent amount of money into a properly designed whole life policy. They might expect the cash value to immediately resemble the total amount they've paid in, but that's not necessarily how cash value insurance works.
Insurance costs and expenses mean the relationship between premiums paid and cash value can look very different, especially in the early years. The National Association of Insurance Commissioners specifically warns consumers that some cash value policies have relatively low cash values in their early years and build later. It also recommends reviewing year-by-year illustrations of future values and benefits. Now compare that with an S&P 500 investment. If you invest money, your account value reflects the market value of your holdings. But that doesn't mean the S&P 500 automatically wins every year. The market can fall, sometimes dramatically. And when the market drops, your account value drops with it. That's the trade-off. The insurance strategy may provide a different pattern of accumulation and contractual guarantees. The stock market strategy provides direct market exposure and potentially much greater upside. So already we're seeing something important. You aren't choosing between two identical investment containers. You're choosing between two different financial structures. Now let's imagine both strategies have been running for years. The S&P 500 account has grown because the underlying investments have appreciated and reinvested distributions. The whole life policy has accumulated cash value according to its contractual guarantees and, where applicable, non-guaranteed elements such as dividends. This is where people often make a huge mistake. They compare a projected insurance cash value with a hypothetical stock market return and declare a winner. But the comparison is only meaningful if the assumptions are realistic. What premium is being paid?
How much is going toward insurance? What are the policy expenses? What is guaranteed? What is merely illustrated? What happens if premiums stop? What happens if the policy is surrendered? And what investment return is being assumed for the S&P 500? If someone assumes an unusually high stock market return while simultaneously using a conservative insurance illustration, the conclusion is predetermined. Reverse the assumptions, and you can manufacture the opposite conclusion. That's not real math. That's sales math. Real math requires putting both strategies on the same timeline with the same cash flow assumptions. The S&P 500 has one extremely obvious advantage: simplicity. You can invest. You own market exposure. The value changes. You can sell investments when you need the money, subject to market conditions, taxes, and the specific account you're using. There isn't a life insurance policy that has to remain in force. There isn't a death benefit to maintain. There isn't a policy loan balance to manage. And there isn't a need to design the insurance contract around a particular financing strategy. But simplicity comes with a price.
Market risk. If the market falls when you need money, you may have to sell investments at unfavorable prices. Imagine retiring during a major market decline. Your long-term average return could look fine on paper, but your actual experience depends heavily on when withdrawals happen. That's sequence of returns risk. The S&P 500 can be an extraordinarily powerful long-term wealth-building tool, but it doesn't promise a smooth ride. Now we get to the reason infinite banking attracts so much attention: liquidity. The idea is that instead of selling an investment to access money, you can borrow against the cash value of your life insurance policy. Policy loans are a contractual feature of many cash value policies. The loan is secured by the policy's cash value, and interest is charged according to the policy terms. That can create a very different experience. Suppose you need money for a major purchase. Instead of selling stocks, the strategy says, keep the underlying policy in place. Access money through a policy loan, use the borrowed money, then repay the loan according to your plan. Sounds powerful, but there's a catch. A policy loan isn't free money. Interest accrues, and outstanding loans can affect the policy and the eventual death benefit.
The NAIC notes that outstanding policy loans plus interest can be deducted from policy proceeds, potentially leaving beneficiaries with less than the policy's face amount. So the phrase, borrow your own money, can be misleading. You're accessing value through a contractual loan mechanism. You're not creating money out of nowhere. Here's where the real math gets uncomfortable. A policy can remain valuable while you borrow against it, but that doesn't mean the loan has no economic cost. You owe interest. And if the policy becomes poorly funded, expenses become problematic, or the loan balance grows too large relative to the policy's value, the consequences can become serious. NAIC guidance notes that under standard policy loan provisions, if total indebtedness reaches or exceeds cash value, a policy can terminate. That's why the strategy requires discipline. A policy loan isn't equivalent to withdrawing money from a checking account. You have to understand the policy contract, you have to understand the loan rate, you have to understand how dividends work, you have to understand what is guaranteed, and you have to understand what happens if the policy eventually lapses. This isn't a minor detail, it's central to the strategy. Now let's talk about one of the biggest reasons people compare these strategies in the first place: taxes. Cash value life insurance can have tax characteristics that differ from ordinary taxable investments. But tax-free is not a magic word. The exact treatment depends on how the policy is structured and maintained.
Policy loans can generally have different tax treatment from ordinary withdrawals, but a policy that lapses with an outstanding loan can create a potentially taxable situation. Investor.gov highlights this risk for variable life policies, and also notes that policy fees, expenses, and loan interest can materially affect outcomes. Meanwhile, investing in the stock market can create taxable events, depending on the account type and what you do with the investment. So the correct question isn't, which one is tax-free? The correct question is, what is the after-tax result under the exact structure we're comparing? That's a much harder question, and it's also the useful one. Now let's bring everything together. Imagine two people have the same long-term goal. Person A builds a properly structured whole life policy intended to accumulate cash value. Person B invests consistently in an S&P 500 index fund. After 20 years, we don't simply compare the headline balance. We compare total contributions, cash value, insurance protection, fees and expenses, loan interest, investment returns, taxes, liquidity, risk. And what happens to the remaining assets at death, because the insurance strategy provides something the S&P 500 doesn't:
a life insurance death benefit. And the S&P 500 provides something the insurance policy isn't designed to replicate directly: broad equity market exposure. So the question becomes, what job are you asking the money to perform? If your primary objective is long-term market growth and you already have appropriate insurance coverage, the S&P 500 can be a straightforward way to gain diversified equity exposure. If your objective includes permanent life insurance, cash value accumulation, and a long-term policy loan strategy, a properly designed whole life policy may serve a different purpose. Those aren't interchangeable goals. So, which one wins? Here's the answer most comparison videos won't give you. There is no universal winner. If you judge only by potential market growth, the S&P 500 has a compelling case because it gives direct exposure to equities. If you judge only by access to cash value while maintaining permanent life insurance, the whole life strategy has features the S&P 500 doesn't offer. But if someone tells you infinite banking automatically produces better returns than the stock market, be skeptical. And if someone tells you the S&P 500 automatically makes permanent life insurance useless, be skeptical of that too. The products solve different problems. The real question is whether the strategy matches the job. And there's another crucial point. You don't have to think of this as an all-or-nothing decision.
A person can have life insurance for protection and separately invest for long-term growth potential. The best financial structure isn't necessarily the one with the cleverest label. It's the one where every dollar has a clear purpose. Here's the simplest way to think about it. S&P 500. You accept market volatility in exchange for direct equity exposure and long-term growth potential. Infinite banking. You accept insurance costs, contractual complexity, and policy loan considerations in exchange for permanent insurance plus cash value access and a different financial structure. Neither eliminates risk. They simply move the risk around. With the S&P 500, the most obvious risk is market volatility. With a cash value insurance strategy, you have policy costs, funding requirements, loan interest, contract-specific risks, and the possibility that poor management can undermine the intended result. That's why the real math isn't one percentage, it's the entire system. And before anyone buys a complex insurance product based on an illustration, the smart move is to examine the actual policy documents: guaranteed values, non-guaranteed assumptions, expenses, loan provisions, and long-term projections. The NAIC specifically recommends understanding which policy values are guaranteed, how values change over time, and whether the premiums remain affordable.
Because a strategy that looks brilliant in a presentation can look very different when you follow every cash flow for 20 years. So, infinite banking or S&P 500? If you're looking for a simple answer, you're going to be disappointed. Because the better question isn't which one makes more money. It's which one is better at the job I'm asking it to do. The S&P 500 is built around market exposure. Infinite banking is built around a permanent life insurance structure and the strategic use of its cash value. One isn't a replacement for the other in every situation. And the moment you understand that, the comparison becomes much more useful. Because personal finance isn't about finding one magic product. It's about putting the right tool in the right job. And that's the real math. If you want more financial comparisons that cut through the sales pitch and show what actually happens to the money, next video, we'll take another popular money strategy and put it through the same test.